Key levels don't predict the future. They tell you where the market has unfinished business. This is what most traders' charts look like. Lines everywhere, zones everywhere, noise everywhere. These were my charts back in the days. Here's the truth. 95% of those lines are useless. There are only a handful of levels that the market actually respects. And in this video, I'm going to show you exactly how to find them. A key level is an important price point or zone where significant expansion or reversal has occurred in the past. That's the only definition that matters. Not every support and resistance level is a key level. Not every previous high or low is a key level. A key level is where the market made a significant move, usually a sweep of liquidity, followed by a strong directional expansion. The four uses of key levels are potential areas for CRT to be formed, zones for expansion and reversal profiles to occur, confluence, stacking evidence in your analysis, framing your trade idea, defining your target, and invalidation. There are four types of key levels. First key level, order block. An order block is the candle or the consecutive sequence of candles that either takes out liquidity or fills liquidity right before a strong expansion. There are two scenarios. The candle digs below a low that makes a bullish order block, or the candle digs above a high and that forms a bearish order block. When price comes back to that zone, that's your entry. Body or wicks, it depends. If price close above the open, use the body. If the wick is larger than the body, use the wick. Match the zone to how aggressively price moved. The second key level is a breaker block. A breaker block is the high that takes out a low or the low that takes out a high. When retested, this becomes your new key level. Think of it as a failed order block that flipped its role. What was support becomes resistance and vice versa. Third key level, a fair value gap. A fair value gap is a magnet. It's a price gap between three consecutive candles, where the first and third candle don't overlap. This suggests an imbalance. Price tends to come back and fill this imbalance. On lower time frames, fair value gaps are the equivalent of a turtle soup zone, high probability re-entry areas. And fourth key levels, just simple swing highs and lows, the most basic but still important. Significant recent highs and lows act as a liquidity pool. The market is always drawn to them. The anatomy of a price swing. The swing high, the high forms the order block at the top, the breaker block forms at the previous high that got taken out, and the order block at the bottom is your buy zone. As you can see, on the right you see the chart with the anatomy of a price swing and which position you should enter based on your prediction. Key levels plus market profile integration. Here's where everything clicks. Key levels by themselves are useless. You need them integrated with market profile. The formula for this is last market profile plus key level presence, and you get the expected outcome. Example for this is if you're in a expansion profile and price is approaching a premium key level, you expect a reversal. That's your short. Wait for a manipulation at the key level, then enter on the expansion downward or upward, vice versa. Example 2. If you're in a ranging profile and price sweeps below a discount key level, that's your manipulation. You expect an expansion upward. That's your long. As you can see, on the right you see two scenarios. You see a range, an expansion, and goes through the key level. That's a strong directional bias. And in the first one you see the range, you see the manipulation and the expansion. That's also a classic CRT. If you look at this like candles, the first candle was a range, the second candle the manipulation made the turtle soup, and the third one the expansion was a distribution phase. As you can see here again on this picture, you see an expansion, and as soon as it hits the key level it reverses at the key level. In the second scenario you see a expansion, it goes to the key level but it digs deeper, forming a manipulation. Most when you see a manipulation you can get a pair that is correlated to the pair you are trading, and you wait for the SMT to be formed before you enter, and then a strong expansion to the other side happens and that forms the reversal. And in the third scenario you see expansion, it touches the key level, it makes a slight retracement. It's just a fake way to trap more buyers even though you're going into a sell. And if you have the right key level, you'll see it disrespect the key level at the first place, and then it will make a retracement and form a order block even on the 5 minutes as an example, and then you can move with expansion more to the downside. And then the logical framework, you use higher time frames to find key levels and lower time frames for profiling. You use the daily key levels along with 1 hour market profiling, for 4 hour 15 minutes, for 1 hour 5 minutes, and for 15 minutes 1 minute. That's what most of the scalpers do. And this is the end of the second video. Key levels are the map, market profiles are the vehicle. You need both. In the next video we're going to time frame selection and alignment, because without knowing which time frame to use and why, you'll always be confused about what you're looking at. And this is the homework that you should at least do once until you get it right. That's it. Thank you for watching the second video. From now on, all the rest of the videos in the mentorship are only to the paid members. This is the only last free video I'm releasing for you guys. Maybe along the lines of 3-4 months I'll be releasing a free course of 6 videos, and then I'll probably be speaking on the basics, more likely in CRT, but a little bit more sauce on that.